So with that, I'm going to introduce our panelists for today. I'm so excited about this. We have been regularly doing student loan updates for you all, and there's been a lot of changes. And Student Debt Crisis Center is an organization that is really in the mix on this and doing a lot of work around it. And so they're doing a presentation today to really let us know about what's going on. So Natalia Abrams is the president and founder of Student Debt Crisis Center. She has been on the front lines of the fight for student loan debt reform for well over a decade. And long before others acknowledged student debt as a genuine American crisis, Natalia was raising awareness of the scale of the problem and working with both borrowers and legislators on lasting, meaningful solutions. Sabrina Calazans currently serves as the executive director at Student Debt Crisis Center, where she advocates for student debt cancellation by putting borrowers and their stories front and center. As a student loan borrower herself and first generation American, she is passionate about bringing awareness to the disproportionate impact of student loan debt. And Sabrina Ashley is the special projects and Free the Degree director at Student Debt Crisis Center. From writing for the Nation magazine to hosting Free the Degree's first summit, Sabrina is dedicated to making diverse voices and perspectives heard. And with that, I'm going to hand it over to the Student Debt Crisis folks.
Awesome. Thank you so much, Ellie, and the NHRC, and all of you for having us today. We're really excited to dive into this. And thank you to Sabrina and Natalia for being here with me. So who we are. We are Student Debt Crisis Center. We're a national advocacy organization with 2 million supporters, and we call for fundamental reforms to student loan policies and an end to the student debt crisis. So some quick reminders. Again, please feel free to ask your questions. You can drop them in the Q&A and we'll do our best to answer as many as possible out loud while we're presenting. We'll also take a brief break between sections just so we can take care of any relevant ones right there. We will be sending a recording and links that will be provided via email. And then super important, any information shared on today's clinic pertains to the current guidelines and rules, and this information is definitely subject to change. So everything today that we talk about is good through today, August 14th, 2025. So today we'll be talking about several different things like loan types, repayment plans, loan forgiveness options. We will again have a Q&A. Again, the information provided today is only good through today, August 14th, 2025. And a reminder for folks, we are not financial counselors or attorneys. We're simply advocates and experts that are here to help you all out. All right, so first we have an opportunity for everyone. So we do have an SDCC volunteer opportunity where we share out resources that can be distributed to loved ones, colleagues, friends, networks, whomever you'd like to share this information with. You can use these resources, especially you all here, to help any clients understand their student debt options. And we know that there are going to be tons of questions that come up today and later as you're digesting this information. So we are going to offer an exclusive hour-long office hour on August 19th at 2 p.m. Eastern for folks who sign up to receive these resources through the Google form that we will drop into the chat. Okay, so we're going to go over very high-level federal updates over the next few slides, just to give you all some context of what's happening and how all this information kind of fits together. So, as a lot of us probably know, there has been a reduction in force at the Department of Education. There was some flip-flop here, whether they were actually laid off or coming back to work, but the Supreme Court did rule that they are laid off. Nobody's coming back. So, this is where we see a lot of consequences like lack of communication and processing delays that we've been hearing about in the news. We do have a lot of income-driven repayment updates. Again, there are major processing delays. Right now, there are more than 1.5 million pending applications. And then additionally, the SAVE plan and the lowest monthly payment options were removed from the IDR application. So, and it's unclear what happened to those applications that were pending with those options selected. Um, we do have a couple of negotiated rulemaking or NEGREG updates. So these are going to be regulatory changes. There is a PSLF NEGREG going on right now, which is going to change who is a qualifying employer. The preliminary rule is coming out soon on changes to PSLF and IDR plans, so we can keep folks updated on that. There's also another RISE NEGREG process that's going on, and this is going to implement changes that were established recently in the Big Beautiful Bill Act. And if the public comment period is not open now, it should be opening soon. Next slide. Awesome. So there are, again, more updates. Defaulted loans collections began in May of 2025. The one good thing here is that Social Security garnishments have been suspended for these default collections. The SAVE plan forbearance, major update here on August 1st. Any loan that was enrolled in the SAVE plan began accruing interest again. This does not mean that the forbearance ended. It does not mean that you need to be making payments on these loans right now. It just means that the interest began accruing on loans enrolled in the SAVE plan. There are also updates for income-driven repayment forgiveness. Right now, loan discharges specifically on the income-based repayment plan have been temporarily suspended while the Department of Education is recounting credits or monthly payments there. So folks are kind of in a limbo there. And then across the board, forgiveness on all other IDR plans. So ICR, SAVE, and Pay As You Earn are all held up in court due to the ongoing SAVE litigation. So right now, loan discharge for IDR forgiveness is paused. Okay, so we've also got some federal lending caps that are going to be taking place. So for grad students, they are going to be limited to $20,500 a year for federal student loans, or a total lifetime limit of $100,000. For professional students, so this is going to be like your lawyers, your doctors, this is going to be limited at $50,000 a year, or a total of $200,000. And then for parents, so anyone taking out Parent Plus loans for a dependent, this is going to be limited at $20,000 per year per dependent, or a total of $65,000 per dependent. So those are going to have massive implications for folks who are pursuing any grad or professional degrees, and then also parents. We also have effective July 1st, 2026, so in about a year, the law established that a new aggregate lifetime loan limit of $257,500 for all borrowers was going to be put in place, and this is regardless of any amount repaid or forgiven. This does exclude Parent Plus loans because you might have multiple children who are going to school and you will be borrowing for. And then existing borrowers enrolled in a program by June 30th, 2026 are exempt from these new borrowing caps for 3 years. So this is going to be kind of a ramp going into these new changes. The last slide here, again, these are all very high level, just to kind of get you in the zone of where we're at right now. So these last updates are the immediate implementations of the Big Beautiful Bill Act. So right now, there are changes to the income-based repayment plan. So the Department of Education is working with servicers right now to remove the partial financial hardship eligibility requirement for the IBR enrollment process. So borrowers who have loans made on or after July 1st, 2014 and before July 1st, 2026 and did not qualify for partial financial hardship will now qualify and be eligible for the IBR plan. For Parent Plus loans, now consolidated Parent Plus loans are able to be enrolled in an IBR plan. Right now, the department will provide additional information to its federal loan servicers and update the studentaid.gov website when that system is available to enable such borrowers to enroll in IBR. So right now, I believe their Parent Plus loans are eligible for IBR, but we're unclear if they're able to actually enroll in IBR. Okay, loan limits for part-time students. This is going to reduce the amount of a loan that a student may borrow for an academic year if the student is enrolled in a program of study on less than a full-time basis during that academic year. We also have updates for public service loan forgiveness. So right now, PSLF is going to allow for payments made under the newly created Repayment Assistance Plan, or RAP, to count toward loan forgiveness if all other eligibility criteria are met. This RAP plan is going to be in effect no later than July 1st, 2026. It's not in effect right now, but basically this bill just made it so that RAP payments made under the RAP plan are going to qualify for PSLF. And finally, we have borrower defense, or BD, and closed school discharge, or CSD regulations. So previously, the Trump administration had BD and CSD regulations that went into effect beginning July 1st, 2020. And then when the Biden administration came in, they made amendments to those regulations. So we're basically reverting back to those old regulations from the first Trump administration. And those are going to be in effect for loans originated before July 1st, 2035. And I do see one question coming up. What do you recommend that we advise those who are on the SAVE plan to do right now? We do have a question or a whole slide on that, so we're definitely going to get into that. Great question. So right now, student loan types and servicers, I'm going to give you a high-level overview of this since I know you all have had previous student loan workshops. So we have this chart here that kind of dissects all the different types of loans. We have three main categories of federal student loans: direct loans, which are going to be newer, Perkins loans, and FELP loans. And Perkins loans and FELP loans are no longer issued, but people definitely still have those loans. The important thing here, we have direct graduate plus loans highlighted in red, beginning on July 1st, 2026. Which feels like the magic date that we're going to be talking about today. Those loans will no longer be issued to student loan borrowers. So those loans are going to be eliminated. On this next slide, we have federal student loan servicers. We've kind of broken this down a little bit so you can see who kind of services what type of loan. In the middle, we have Advantage and Mohila. Those are going to service all types of federal student loans, whereas the ones highlighted in red on the left are going to just service direct loans, and the ones highlighted in blue on the right are only going to service FEL and Perkins loans. So when you're kind of helping people out, you can keep this in mind of, okay, what kind of loan do they have? What are they eligible for, etc. And on this next slide, we did pull a few of the most common banks and private or refinancing companies that service private student loans. This is helpful for if you're trying to decipher what type of loan any people have that you're helping. The tricky part here is that Mohila also services private loans in addition to federal student loans. So you're probably going to want to head to studentaid.gov to see that full list of federal student loans for someone or yourself if you're figuring out if you have a federal or private student loan. Okay, so student loan repayment options. This is where it's going to start getting a little bit more tricky, but we've done our best here to separate out what's happening now and what's going to happen in the future. So we have kind of these blue slides and these green slides in this next section. Blue, and I'll walk you through this and remind you again, is what's happening right now. Green slides are going to be is changing in the future. So again, we have federal repayment plans for loans disbursed before July 1st, 2026. Um, so we have three main categories of repayment plans. We have the standard plan here. We have alternative plans, which have additional plans under those. And then we have the income-driven repayment plans. And we do have SAVE highlighted in red. No one can apply for SAVE anymore, although folks are still enrolled in SAVE, so that's why we still have this up. And then not everyone is eligible for IBR and pay. Again, though, the financial hardship requirement for IBR is being taken away, so that will change. So on this next slide, this is a green slide. So this is what's going to happen on or after July 2026. Folks who have a federal student loan that's taken out on or after on or after July 1st, 2026, they're going to have two repayment options, the new standard plan and the RAP plan, so the repayment assistance plan. Um, Something important to note here is that for folks who consolidate their loans on or after July 1st, 2026, they are also going to lose access to all of those old repayment plans. So those consolidated loans are going to be treated like a new loan. So that's really important. And then also, again, wrap is slated to begin on July 1st, 2026. So this is definitely, we have time to figure out our options here and what to do. Okay, so on this next slide, we're going to talk about what's happening now. This is the blue slide. So we're going to talk about the 10-year standard repayment plan. So this is what borrowers are initially placed in. It's a 10-year repayment plan with fixed monthly payments. You pay the entire loan balance. There's no forgiveness aspect at the end of the line. This 10-year period repayment period applies to anyone with an unconsolidated loan or for folks with consolidated loans but are at a balance of less than $7,500. So this plan is good for folks who are looking to either get out of the system quickly, just get out in 10 years, wipe your hands clean of it. If you're worried about accumulating interest, this might be the plan for you. Or if you just want to make a big dent in your debt, again, you might want to consider this 10-year standard repayment plan. However, the payments can definitely be steep and they're not always affordable for borrowers. So we also have right now the 30-year standard repayment plan. So this is for those folks who have consolidated loans or that larger loan balance. So you're going to have this repayment period that corresponds to your student loan debt amount. And we've pulled a screenshot here so you can kind of see that breakdown. So again, you're going to be in this repayment plan until you pay off the entire balance. There's no forgiveness aspect at the end of the line here. And again, these payments can often be pretty steep for borrowers. So there, again, are those other options for folks right now to consider. So on this next slide, we have the new standard repayment plan. So this is what's going to be available for folks with loans who take out loans on or after July 1st, 2026. Again, that magic date. So this has a bit of a different breakdown for your loans. It is based off of your loan balance. So you can see that anyone who borrows under $25,000 is going to have a repayment term of 10 years. But if you borrow over $25,000, you're going to have increased repayment periods. So borrowers pursuing public service loan forgiveness should note that only payments in a 10-year standard plan are going to qualify for forgiveness. That is true now, and it's going to stay true later after July 1st, 2026. The only difference is they're not going to distinguish between a 10 and a 30-year standard plan. It's just all going to be called the standard plan. So it seems confusing, but that part actually is pretty much staying the same. And then one other important note here is that beginning on July 1st, 2026, again, if you're Parent Plus borrower and you take out your loan on or after July 1st, 2026, those Parent Plus holders will only have access to the standard plan. They're not going to qualify for the WRAP plan. So that's going to be a big hit. Okay, so we're going to switch into alternative plans now. And these plans are all variations of the standard plan. So there's no forgiveness portion. You're going to pay off the entire balance. And this is available to folks right now with loans. But these plans are going to um, disappear for folks with a loan issued on or after July 1st, 2026. So again, available now, won't be available in the future for newer borrowers. And we have three main plans here. We have extended repayment, graduated repayment, and extended graduated repayment. All loans are eligible for these plans except for Perkins loans. If you have Perkins loans and you need to be in one of these plans, then you can consider consolidating your loans. But that's a big decision, so be careful if you do that. So the extended repayment plan is a repayment plan with fixed payments. Your repayment timeline is going to be 25 years, and it's only available to folks with a balance of $30,000 or more. The graduated repayment plan is where your payments are going to start low and end high. They're going to increase every 2 years. And your repayment timeline varies based off of your loan type. So a FFEL or direct consolidation loan is going to be 10 to 30 years to repay, and that's going to be based off of your loan balance. But if you have any other type of loan, then your loan repayment period is going to be 10 years. And then finally, we have this extended graduated repayment plan, and this is a combination of those other two plans. So the loan eligibility, again, is the same. All loans qualify unless you have a Perkins loan, then you need to consolidate it. The repayment timeline is going to be that 25 years, but the payments are going to be graduated. So they're going to go up every 2 years and start low and end high. And it's only available to folks with a balance that's higher than $30,000. So again, these plans are available now. They're not going to be available for folks who have loans that are issued on or after July 1st, 2026. So that's a little bit about repayment plans. I'm going to toss it over to Sabrina Calazans, who's going to talk about IDR plans, and go ahead and take it away.
Perfect. Thank you so much, Sabrina. Ashley, really appreciate you going over that. I also want to let folks know, I know there was one question in the Q&A here before that folks that have interest in working with SDCC and getting a webinar specifically to your clients, to your organization, you can feel free to reach out to us at info@studentdebtcrisis.org. We'd love to speak with you a little bit further about what we can do to support you all. And then I do want to look at this question here in the Q&A from Sheila that asks, can a student loan borrower change their servicer if they are unhappy with their service? Unfortunately, you cannot. The only way that someone changes their loan servicer is essentially if your loan servicer is getting out of the portfolio and you get moved to someone else, or when you are consolidating, you do have the option to select who you would like to be moved to. Otherwise, you are unfortunately stuck with the loan servicer that you have. Um, all right, so I know that Sabrina Ashley just did a great job going over all of this. We are going to jump into the specifics of IDR plans, income-driven repayment plans, as well as the new RAP plan and what that means for you. All right, so benefits of income-driven repayment plans. So the monthly payments for an income-driven repayment plan is going to be calculated as a percentage of discretionary income, which is based on your income and your family size, not the loan amount, which is why Sabrina Ashley said that it could often be unaffordable on the standard plan in comparison to an IDR plan. One big change here is that when we get to the RAP plan in a few minutes, the RAP plan is going to change what those payments are based on. They're going to use adjusted gross income instead of discretionary income. As a result of this, borrowers could see their monthly payments increase. Monthly payments may be more affordable than the standard plan and could help prevent default and delinquency by lowering their payments. This is especially helpful for folks who have lower incomes, those who may have lost a job, or who have decreased incomes. So if someone's struggling, if they're making a low income, they can consider enrolling in an income-driven repayment plan to lower that monthly payment and make sure that they're not behind and falling into default and delinquency. Loan forgiveness is possible for loans enrolled in an IDR plan. Unlike the standard plan, you're not going to pay off the entire balance. Your goal is to make payments over 20 to 30 years, depending on the plan. And after you've made those payments, you would have your loans forgiven. But it is really important to note that periods of deferment, forbearance, and default do not count towards this IDR forgiveness, including the SAVE forbearance. And we are going to get into SAVE very shortly. All right. Income recertification. This is a question that we get a lot from folks. What does that mean? Essentially, every year, borrowers need to recertify their income. They need to document changes to income and family size. So if their income goes up, their monthly payment will also go up. But if it decreases, their payment will also decrease. This can be completed by filling out the IDR application online at studentaid.gov. And there is also a paper form available for folks to fill out. Right now, no one needs to recertify their income. This is a question we're getting very frequently, but no one needs to recertify right now until February 2026 at the earliest. If you do anticipate that your income is going to increase after or around February 2026, you might want to recertify now while you have a lower income, excuse me, so that you're able to lock that in for 12 months versus when your income increases and then you have a higher monthly payment. Now, ideally, you should recertify every 11 months because you technically need to have your recertification in 10 days before the 12-month mark or the year mark. And it's also important to note that if your wages decrease or change during the 12 months, you can always call your servicer or go online and tell them that your income has changed so that your payments can reflect the change in income. Again, if you lose your job, um, except for the RAP plan, which we will get to soon, if you're enrolled in any of these other repayment plans and you lose your job and you're making $0, your payment should reflect that. So you can always call ahead and let folks know. Now, this is also something that's really important, talking about how income-driven repayment plans factor in with taxes. So something that we're asked quite frequently is about tax filing status. So if you are married and filed jointly, they are going to take both incomes into consideration. If you were married and are filing jointly and you're now separated or divorced, or if you can't access your spouse's current income, the department will not factor in your spouse's income or loan debt when calculating your IDR payment. If they are factoring both incomes into consideration, they will also take the loan debt that your spouse has into consideration to lower your monthly payment as well. Now, if you are married and file separately, spousal income is not considered when they make that calculation of what your monthly payment will be. Something that we are following very closely but are very concerned about is that at the end of this year, so on December 31st, it is the end of tax-free student loan forgiveness at the federal level, unless it is extended by Congress. So beginning in 2026, on January 1st, any student loan forgiveness is going to be taxed as income. So as an example, if you have $50,000 forgiven through IDR forgiveness, this is separate from public service loan forgiveness. We will be discussing that later. So if through this IDR forgiveness, you've made the payments between 20 to 25 years, you have 50,000 forgiven, you could owe taxes as if you earned an extra $50,000 in income for the year. So if you're looking at a 22% tax bracket, that is a tax bill of about $11,000. That is quite steep for someone. But as Sabrina Ashley pointed out, we are not tax professionals or financial counselors. So if you do have questions, I do highly recommend either you or your clients reach out to a financial counselor to talk more about what that means for them if they get this forgiveness. Um, and then a really important note here for anyone trying to switch their repayment plans right now, as Sabrina Ashley said, there is a huge backlog of at least 1.5 million applications. What we have heard from our partners and from folks is that if when you're applying for an IDR plan, you opt in to the IRS integration, which essentially allows the Department of Education and the IRS to communicate to calculate that monthly payment for you. If you opt into that, you will not need to document income and provide like a W-2 or tax returns. You can just opt in and they will actually process your application a little bit faster than if you do that income documentation. So something to take into consideration here. Another question we're seeing a lot of is what is the difference between IDR and IBR? And I know it all could sound the same at times, so I want to just quickly go over what the differences are. So IDR, income-driven repayment, is the umbrella term. It's the category and the name of the overall program. So the income-driven repayment program. IBR alongside ICR, Pay and Save are types of IDR plans. So again, IDR, income-driven repayment, is that category, the umbrella term, and then these are just examples of IDR plans. All right, so if we're looking at the different existing income-driven repayment plans, we're looking at the pay plan, which looks at 10% of your discretionary income over a 20-year repayment term. This new version of IBR, which is for folks who have loans after July 2014, looks at 10% of your discretionary income over a 20-year period. The older version of IBR looks at 15% of discretionary income over a 25-year period, and the income contingent repayment plan, which was the only plan available to Parent Plus loan borrowers, is 20% of discretionary income over 25 years. All right, so let's look at the upcoming changes to these income-driven repayment plans. So right now, anyone enrolled in Pay as you earn in the SAVE plan or an income contingent repayment can remain in these plans until they are phased out by July 1st, 2028 at the latest. So essentially, the budget reconciliation bill said that these plans are going to be eliminated by July 1st, 2028, but that is the latest. So it can happen before then. What we know is that if anyone is looking to enroll in Pay or ICR, you will need to enroll in these plans before July 1st, 2026. So July 1st, 2026 is essentially the cutoff. You're either in the plan or you're not. So borrowers will no longer be able to apply for those plans after that date of July 1st, 2026. And that excludes SAVE. As Sabrina Ashley said, no one can apply for SAVE in this moment. So again, these plans are going to be phased out by July 1st, 2028 at the latest. And if you want to enroll in these plans but are not currently in Pay or ICR, you will need to apply and be enrolled in it before July 1st, 2026. So existing borrowers that are currently in Save, Pay, or ICR, um, if they do not choose to get out of that plan between that July 1st, 2026 date and whenever they decide to fully eliminate the plans, let's say it's July 1st, 2028, if they don't get out of it because they will need to get out of those plans by the time that the plan is cut off, anyone with direct loans will be placed in the WRAP plan. Anyone with FFEL loans will be placed in the IBR plan, and anyone with direct consolidation loans, including those that previously paid a Parent Plus loan, will be placed in the IBR plan. I know that's a little bit confusing. We're going to keep breaking that down and talk about what that means. But essentially, there is going to be a time when no one can access these plans, which is July 1st, 2026. And then for anyone enrolled in those plans following July 2026, there is going to be a period of time where you can stay in the plan, but at some point it is going to go away and you will need to make a decision as to what other plan you will want to enroll your loans in. And then it's really important to note, again, as Sabrina Ashley said, that the WRAP plan will be offered to all borrowers except Parent Plus holders, which is very unfortunate. All right. I just want to take a quick look at the Q&A. I'm seeing a couple of questions come in. If currently under the graduated plan, will they need to change in 2026? Sonia, no, you can stay in the alternative plans in graduated, extended, or extended graduated. You will continue to have access to those plans. It's just for anyone who takes out a loan on or after July 1st, 2026, you won't have access to it. But all of those plans will continue existing for anyone who is currently a borrower who has loans right now and does not plan on taking out any loans in the future. If you do take on loans after July 1st, 2026, but you also have loans now prior to it, you will lose access to all of the existing plans and will only have access to the standard plan and the WRAP plan. You can't separate the two different buckets of loans into the older versus newer programs. They're all going to be subjected to the newer plans. That is really important to note here. For a client who is not aware their loans were no longer in deferment and now sent to collections, do they have the opportunity to recertify? Shelley, we are going to go over default and delinquency for folks who are behind on payments, as well as deferments. We're going to talk about that and what that means for folks and how they can get their loans back into good standing. Gentleman graduated in 2008 has payments. So Vivian, essentially for income-driven repayment plans, you either have to be on a $0 payment that does count towards the number of credits that you need or the time needed for loan forgiveness, or you have to actively be making payments. If someone is consistently in forbearance as a time and the forbearance unfortunately does not count towards that 25-year mark, you need to actively be making payments. So any periods in forbearance will just extend the repayment term past the 20 or 25-year mark, fortunately. And then Mary Ann asked here, are there any groups fighting this changes? This is insane and will ruin future home buyers. And for debt to be counted with income at tax time is even more insane. This needs to be stopped. We completely agree, Marianne. We are an advocacy group. We are constantly updating folks about these changes. We're making sure that folks are aware. We're trying to connect folks to their lawmakers' offices. We're trying to connect them to these negotiated rulemaking processes where you can submit public comments talking about why and how you oppose these changes that are coming. It's very frustrating. We're essentially having to relearn the entire student loan program, and we know that this is going to financially harm many folks, especially those thinking about home ownership who are in the process of it. And to see all of these changes is really heartbreaking. And if folks are interested, again, reach out to us. We could definitely talk about how folks in the housing counselor community, folks in your space might be interested in drafting a sort of letter to lawmakers or drafting a letter to whoever it may concern about your reservations when it comes to all of these changes. We can absolutely talk about that. All right, I'm going to continue on here and then I will take a look at the questions that have been dropped in the chat. So again, a reminder, please use the Q&A. It's a little bit hard to navigate the both of them. Okay, so let's jump into the WRAP plan. This is really important. This is going to be one of the biggest changes when it comes to student loan repayment. So WRAP is slated to begin on July 1st, 2026 or prior, according to the Department of Education. So at the latest, it's going to begin on July 1st, 2026. So current borrowers and new borrowers have access to this. So it's not just anyone with the loan on or after July, but it is for everyone except for folks with Parent Plus loans. Again, Parent Plus holders are constantly being let down and excluded from the existing repayment plans. It's very frustrating, but unfortunately, they do not qualify for WRAP. So the repayment term on WRAP is also different from the existing repayment plans. WRAP is going to be lengthier than the existing plan. So it's going to be over a 30-year period, essentially a mortgage, right? It truly is getting crazy and out of hand. So a couple things here for you to know when it comes to WRAP, and then we're going to show you a chart as to how they are calculating the adjusted gross income and the impacts to dependents. So some things to note. $0 payments will no longer exist under the WRAP plan. There's going to be a minimum of a $10 payment, even if you're unemployed. So when we're looking at a plan like the income-based repayment plan, if you're making $0, your payment is $0. That is no longer the case on WRAP. You're going to have a minimum of $10 payments. The WRAP plan tries to be like the SAVE plan in one way, where it will waive any interest not covered by the borrower's monthly payment and will reduce borrower's principal by up to $50 if the payment does not do so. But again, we're looking at a lengthier repayment period and it's not accessible to all. Um, it's also going to be based on 1 to 10% of adjusted gross income. So it is going to be more expensive. It's less generous than that discretionary income calculation for the other IDR plans, and it's generally going to be more expensive than SAVE. It can even be more expensive than the standard plan. Um, and it's going to especially harm lower to middle income folks who are already struggling. So that is also really important to note. And then one thing that we are trying to connect with our lawyer friends, with our partners to try and get some clarity here, um, because there's no guarantee that if you have a loan prior to July 1st, 2026, that if you choose to enroll in the WRAP plan, that you will be able to switch out of WRAP and back and into IBR. So if you go into WRAP and you say, no, this isn't working for me, it's too expensive, I kind of want to get out of it and go to IBR, there's no guarantee that you'll be able to do that. You will be able to switch to the standard plan. That our lawyer friends have agreed that that is a reality, that is something that can happen, but again, no guarantee that you can go from WRAP to the income-based repayment plan. So be very careful about that. That will limit your options here. Now, looking at this chart that is courtesy of the National Consumer Law Center, our lawyer friends, this is what it will look like if someone is enrolled in the WRAP plan. So if you're making $10,000 to $20,000, it's going to look at 1% of your income, which will mean that your payment will be between $10 to $16. Seems reasonable. But then we start looking at the other numbers, and if you're looking at $70,000 to $80,000, that's going to look at 7% of your income. And it will be about $408 to $466 a month. And this is before subtracting $50 per dependent. So for each dependent, there's going to be a subtraction of $50. So again, if you look at this in comparison to the other repayment plans, and especially in comparison to SAVE, it is significantly higher. So something for folks to keep into consideration. For incomes that are greater than 100,000, it is capped at 10%. It's not going to be higher than 10%, but that monthly payment is going to be 833 plus. We don't know exactly what that means, but it's going to be higher than that. So definitely keep that in mind for yourselves and for your clients as well. Parent Plus loans, again, I just want to go over this because this is really important here. What are the qualifying repayment plans? Income contingent repayment is the one that is in place right now. You can absolutely get into ICR. You do need to consolidate your loans if they're not already consolidated in order to get into ICR. The same thing applies for IBR, but that is a recent implementation of the Big Beautiful Bill. And so we do know that there is a bit of a lag when it comes to the servicers making sure that folks can actually get into IBR. So if someone tries to apply as a Parent Plus holder for income-based repayment and they're denied, they may want to wait maybe a couple of months or something along those lines to see if they can get in the second time. It's not because they don't qualify, it's because the servicers are still getting their system set up essentially for them to be able to apply. And then Parent Plus holders with loans prior to July 1st will have access to alternative plans, the extended graduated and extended graduated. For the new Parent Plus borrowers on or after July 1st, or anyone who consolidates on or after July 1st, you will only have access to the standard plan, not the wrap plan. For Parent Plus folks specifically. So if you have Parent Plus loans on July 2nd, 2026, and you say, I want to consolidate all my loans, you can't access wrap, you can't access ICR or IBR. So at that point, it might not be worth consolidating unless you really, really want to. Again, a quick refresher on the lending caps that are going to take place on July 1st, 2026. It's a 20,000 per year per dependent cap, as well as a 65,000 total cap per dependent. So we are recommending right now Parent Plus borrowers who have loans prior to July 1st, 2026. So anyone that you might know, any clients you might know who are thinking about getting on an income-driven repayment plan, so either income contingent repayment or income-based repayment, they should consider consolidating now and enrolling in that plan so that in the future they're all set. They don't have to worry about it. Essentially, again, any consolidation after or beginning on July 1st is going to exclude you from these income-based plans. And we don't want folks to be harmed financially and to be excluded from these plans that could essentially lower your monthly payment. So something to consider if you or someone you know has a Parent Plus loan, they're thinking about getting into one of these income-driven repayment plans, please tell them to consider consolidating now. It's really important that they take action before that July 1st deadline. All right, so if you want to apply for an IDR plan, you can do so online or through the paper application. If someone can drop that in the chat so that folks can access it, that would be great. It's also, as Sabrina Ashley said, there are extremely long processing times. They're extremely delayed, and so it can take upwards of 60 days. That was on the shorter end of things, but it could take even longer. The process is you submit that application. You should be placed into a processing forbearance where you essentially are not being billed, you're just waiting on them to process that application. If you receive a bill and you're not placed into that forbearance, we recommend calling your servicer, telling them, I have the right to be placed into this forbearance, please put me in it. And again, if you opt into an IRS integration when applying for an income-driven repayment plan, your application has a chance of being processed more quickly than if you submitted a paper form or document income like a W-2. And this is just some information that you should have on hand with you when applying for an IDR plan. Either your clients should have their permanent and or mailing address, family size info, employment information, and employer address. And if you choose not to opt into the IRS integration, you will need to choose to upload a W-2, a pay stub, an employer letter certifying your gross income, bank account statement, or an interest or dividend statement. That is all important information to keep in mind. And if you're looking to identify what your monthly payment will be on different plans as you're making your consideration, you can go through the loan simulator at studentaid.gov, although it is worth noting that it is not 100% accurate when it comes to the monthly payment amount. The calculation for the standard plan tends to be accurate, but most folks go through it to figure out their income-driven repayment plan options. And so that is often difficult to find out. So if you don't have time to call your servicer, um, and you just need a quick, answer, that might be the best option. But if you do have time, I do recommend calling your servicer directly. Um, where you'll get some more accurate numbers regarding your plan eligibility and monthly payment amounts. So you can call and ask, what repayment plans am I eligible for, and what are the estimated monthly payments? And if you're working towards public service loan forgiveness, you should mention that so that they will lay out essentially the plans that are qualifying repayment plans for that program. All right, so again, a quick recap here of the changes. So for current borrowers, anyone who has a pre-July 1st, 2026 loan, the repayment plan options that are available to you are the existing standard plan, which is that 10-year or 30-year option. The income-driven repayment plan options that are available to you are IBR, income-based repayment, income contingent repayment, the pay-as-you-earn plan, and SAVE if you've already applied for it. No one else can get into SAVE. And then the alternative plans of extended and graduated. Those are all still available. The date to remember, of course, July 1st, 2026. That is going to be the cutoff for enrolling in ICR or pay if you want to enroll there. Parent Plus loans must be consolidated and enrolled in ICR in order to be eligible for it, to not be cut out and boxed out of the option. Um, and all loans not enrolled in ICR or pay um, can no longer apply after July 1st, 2026. That is the cutoff date. For new borrowers beginning on July 1st and after, um, they are subjected to the new standard plan, which is 10 to 25 years, depending on your loan balance. This is going to be the only repayment plan option for new Parent Plus loans, unfortunately, which is going to be high in many cases. And any loans consolidated after July 30th, 2026 will also have more limited repayment options, meaning just standard and wrap. And for all borrowers, you will be able to access the wrap plan with the exception of Parent Plus loans. That again is a 30-year repayment period with a minimum of a $10 payment and is based on 1 to 10% of your adjusted gross income. All right, the SAVE plan. I want to make sure that we go into this because there are nearly 8 million folks currently in the SAVE plan trying to figure out their next steps here. All right. For SAVE, as many know, there are current lawsuits that are blocking the SAVE plan. So these cases are still ongoing. The SAVE plan has been removed from all existing income-driven repayment applications and no one can apply for the plan. All borrowers enrolled in SAVE are currently placed in a forbearance, meaning that there's no payment required. As Sabrina Ashley said, on August 1st, interest began accruing for anyone enrolled in SAVE. Public service loan forgiveness and income-driven repayment credits are not being granted for any time spent in the SAVE forbearance. That is not counting. Folks can use a program called the PSLF buyback program to try and buy back the time spent in the SAVE forbearance to count towards public service loan forgiveness. So I see Laura left a comment here in the Q&A saying, I have direct loans in the SAFE plan. I applied for PSLF forgiveness since I started paying in November 2013. Was told that even the loans that had been in forbearance under SAFE were added to payments made. Is this true or did I misunderstand? So Laura, if there are payments from the SAFE plan that are not being counted, you can use this PSLF buyback program to try and buy back that time. Natalia is going to cover that in her section. So we are going to discuss what that means and what that looks like for folks. All right, so the big question is, should I get out of SAVE and apply for another IDR plan? So and I want to start by saying there's no right or wrong answer here. It truly is a personal decision. We are just laying out the reasons as to why someone might want to consider getting out of it or why they want to consider sticking with it. So you might want to consider getting out of SAVE if you want to continue making progress towards public service loan forgiveness. If you're almost at 120, you might just want to get out of it and keep making that progress and get out of the system as soon as you can. If you want to continue receiving income-driven repayment credits and work towards a 20 to 25 years of forgiveness, this is a good option for you as well. If you're especially close, as I just mentioned, you may want to consider switching into the income-based repayment plan, IBR specifically, if you're looking to get forgiveness through the IDR forgiveness. Um, as Sabrina Ashley said, right now it's temporarily suspended, but once the suspension is lifted on the IBR plan specifically, your loans would be eligible for discharge. The same does not apply for the pay as you earn or ICR, because those are currently held up in litigation alongside the SAVE plan. So our recommendation for anyone working towards IDR forgiveness is to look into the income-based repayment plan if you qualify. Now, anyone who does not mind not receiving PSLF or IDR credits, or anyone who is benefiting from not having to make a payment and doesn't mind interest accruing, you can consider sticking with SAVE and just waiting until it goes away and then getting into another plan of your choice. But again, up to you on what you'd like to do. IBR will still be an option for you, so that is something you can take advantage of after the SAVE plan. All right, what if I can't afford my payments? So if you have checked your IDR eligibility options, and you still can't afford the minimum monthly payment, you should consider applying for a forbearance or deferment as a temporary emergency option. So a forbearance and a deferment are essentially the same thing, that they pause payments, but there are a few differences to what they actually mean. Um, so forbearance allows you to temporarily stop making payments or temporarily make smaller payments. So usually you won't be making progress toward forgiveness or paying back your loan during a forbearance. It does not count, as I had stated earlier, and interest will accrue during the forbearance. You can choose to pay the interest if you'd like, but again, most folks get into it because they're struggling financially, so we understand if they don't. A deferment also allows you to temporarily stop making payments with interest accrual, but there are different scenarios and different types of requirements for a deferment. So if someone is undergoing cancer treatment, economic hardship, a graduate fellowship, if you're a Parent Plus borrower, if you're going through unemployment deferment, all of those are options for folks in these specific scenarios. If you don't fit with any of these descriptions, you can just opt into a forbearance, which is less strict about who qualifies for it or not. All right. I just want to make sure that I'm not over on my section. I forgot where I was supposed to end. 1 second. Okay, I'm good to keep going here. So what happens if I don't make payments? So the first day past due, the payment is considered to be delinquent. The loan will remain delinquent until missed payments are made up or a deferment or forbearance is granted for delinquent periods. So that is important to know. If you are in delinquency, if you're behind, you can use a deferment or a forbearance to get out of that. Now, once you reach 90 days past due, that's when we see a big hit to people's credit scores. That's going to be reported after 90 days. I don't know if you've seen headlines, but there have been headlines coming out of New York and other states that are talking about how people's credits are being hit right now. That is specific to delinquency and default. There are negative consequences that come with this, unfortunately. And after 270 days being past due, your loan is considered to be in default. So that's about 9 months. So the consequences of default does include tax refunds being withheld, wage garnishment about 15 to 20%, and on the extreme level, they can even go up to withholding your passport. Now, we have not seen instances of passport withholding, but it is a scenario that is a possibility here for folks who are in default. For folks who are in default, there are ways to get out of it. There is loan rehabilitation or loan consolidation that can be done to get out of default. I believe there's an explanation on the next slide. Yes, so default collections resumed on May 5th. Again, the garnishments on Social Security are being paused according to the department. A big change coming is that on July 1st, 2027, borrowers will be able to use loan rehabilitation to get out of default twice. So loan rehabilitation is normally a one-time opportunity, but it is going to be opened up to 2 times now. So loan rehabilitation, it's a bit of a lengthy process. You will need to get on the phone with your servicer. You'll need to talk about all of your finances. You're going to be asked many questions. And at the end of the day, they will present an agreement to you in which you'll have to sign and get back to them during a certain amount of time. And you will need to make 9 monthly payments over the course of 10 months. It could be as little as $5. And you will work with the servicer to determine that monthly payment. So you'll make those payments. Once all of that is done, the collections will stop. That is the loan rehabilitation process. That's one way to get out of default. A more simple way to get out of default is by consolidating your loans. However, if your loans are already a singular direct consolidation loan, you cannot consolidate further, so that is not an option. But if you have multiple loans, this is a possibility for you. It's the most simple way. So essentially, you're converting or combining your loans into a single direct consolidation loan, creating a new loan, and paying off the defaulted one. So to qualify for this, you must either agree to repay under an IDR plan, or make three on-time payments, excuse me, before consolidating. You can consolidate a single loan. So if you have a direct loan, just a direct subsidized or direct unsubsidized, you can consolidate that into a direct consolidation loan. So those are the two options to get out of default. Loan consolidation is the most simple one. But if that's not a possibility, loan rehab still does exist. All right. And then this is one of the other changes that are coming as a result of the reconciliation bill. So changes to economic hardships and unemployment deferment. So borrowers that take out loans after July 1st, 2027, so we still have a little bit of time here, will not be able to use economic hardship or unemployment deferments to pause payments if they cannot afford them. Again, this is very, very frustrating to see. The options for folks in 2027 will be either standard or wrap. We know that wrap doesn't offer a $0 payment. And so if folks are trying to get into an economic hardship or unemployment deferment, they will no longer have access to that. They will still be able to access forbearances, but it will only be for up to 9 months during a 2-year period. So it's going to be shortened significantly in comparison to right now, which I believe you can do 36 months directly on a forbearance. And so it is going to be tougher for folks who are facing financial hardship in 2027 to access deferments and forbearances. All right, with that, I'm going to kick it over to Natalia, who's going to go over PSLF and what we know about the changes coming. Natalia?
Great. Thank you so much, Sabrina. And just claps to you. This is so much information. I wanted, before we get into this, I will be answering some of your PSLF questions. It will be quick as it's a review for many of you, but just taking a look at the questions. Okay, so for Retta, for students whose loans have been forgiven already, will these loans be reinstated? We have not seen that with anyone, just letting you know. It sounds like you have. You said it, at some point they were fishing that idea around. You have a client whose loans were forgiven after he paid the loan off. It was $2,000. After he sent his last payment, the servicer sent the money back to him. My first question would be, did they send the money back or did he receive a refund? For overpayment, borrowers are entitled to a refund with forgiveness or with public service loan forgiveness. And now they're asking for this back. Rhoda, if you can email us, I'd like to look into this further. We are not hearing, just for everyone else listening, of the Department of Education asking for any money back right now. Similarly, I see Jill asked about the one-time account adjustment that happened during President Biden's presidency, and whether or not people will lose those months. Jill, we share your concern. We have not heard any updates on this, so I don't want to send any panic. But if you all remember, there was an IDR tracker that was on for many borrowers that was first taken down, then it was put back up, then it was taken down. But right now we have income-based repayment forgiveness paused, and they're saying they're kind of doing a reaccounting of the loans. We are concerned about this. If you see any borrower that has had their credit count changed, previous workshops, we were telling borrowers to take screenshots of that IDR tracker to then see if those numbers change. It's very hard now that the department has taken down those numbers. And then Ada, apologies if I'm not saying that correctly, for house size for current income driven repayment programs, and I would defer to you, Sabrina Calazans, for the RAP plan, but they do look at your house size, or how many people, family size is how I believe it's put. They do not look at cost of living, but your loan payment can be lower based on dependents. And if you are expecting, that counts as a dependent as well, just to make sure you get as much money off that monthly loan payment as possible. Okay, and then I believe I saw a question on just what are Parent Plus loans. I'm not sure if that got answered. Those are loans that are given to the parent at a higher interest rate. They are federal loans given to the parent versus the student. Many families have a combination of both Parent Plus and private, or excuse me, they have all of them, but Parent Plus loans and federal loans that are given to the student. We always say Parent Plus loans are student loans. They just are treated differently, as you saw with Sabrina speaking to that, and do not have the same federal benefits as the federal student loan. All right, let's talk about public service loan forgiveness. Again, this is a high level overview because I'm sure if you've been on workshops, either with us or with NHRC, you have heard this before. But the program started October 1st, 2007. Why is that important? It's important because while we applaud any public service work done prior to that, this is when the time started counting towards actually getting public service loan forgiveness. You have to make 120 payments or 10 years of payments, on-time payments for approval. I did see a question if somebody could make, Ida asked if you could make extra payments to make that 10 years a shorter amount of time. You cannot. It has to be done 120 monthly payments each month. There is no way to shorten the time. Then we have the plus time for application and approval. The borrower has to stay in the program and making payments, in their public service job, making payments even after the 120 months until their loan is forgiven. This is something we have been just screaming at the top of our lungs to the Department of Education, because we see borrowers sometimes working 6 months, 1 year, where their application has been in limbo after they've hit the 10 years, and they have to continue making payments. They have to stay in their job. This is where the refund kicks in, that technically the borrower should get a refund for overpayment, but make sure that your clients or yourself stay in your public service job until you have the application approved. Another point, payments are cumulative, not consecutive. We know many people go in and out of public service work. And so it is not something that you have to do 10 years straight. You can work for 2 years, go in and out, make sure, and we stress this all the time, to keep your records as much as you shouldn't have. The onus shouldn't be on you. You and your clients must keep your records of the amount of time worked. And then it's after 10 years, all remaining debt is tax-free. So there's criteria to check for and steps to take. You must have a direct loan. You can consolidate into a direct loan if you have the older FFELP loans that were given out prior to 2010. You can also consolidate your Perkins loans. Parents can consolidate. You can consolidate a single loan, and we will talk a little bit about consolidation later, but you can consolidate a single loan into that. The parent must be working in the public service job, not their student. Does your employer qualify? Do you work for a C3? Do you work for the federal government, state, local levels? All qualify. Are you in a qualifying repayment plan? All of the income-driven repayment plans, that umbrella that Sabrina showed us, those all qualify. The alternative plans do not qualify. Time spent in forbearance does not qualify. In addition, defaulted loans do not qualify. All of those loans can be brought into good standing and can qualify. So it's not all lost. As I said before, please document your employment using the Public Service Loan Forgiveness form that you can find at studentaid.gov, and check it all and reapply after the 120 qualifying payments, which is 10 years. So one of the best ways, when the system is working properly, is to combine an income-driven repayment plan, meaning you have the lowest payment possible, with public service loan forgiveness to have the maximum benefit. If you work or plan to work for a PSLF employer for 10 years while you're in repayment, the strategy is to, pay as little as possible. This is an all or nothing type program, though. You have to work the 10 years and that plus until your application is approved. It is not, we sadly speak to many borrowers who did 8 years and then went out of public service. That does not count for this program. So before we get to buyback, let me just take a look at the questions. Okay. So 2 years working in a so Laura asked, I have 2 years working for a nonprofit that closed and isn't being counted by studentaid.gov, even though I submitted my W-2s with the application. How do I get those to accept the 2 years? My first thought, Laura, would be to reapply. I do want to, we can hold this Sabrina's, but I do want to lean on one of the Sabrina's to see if there's any other advice in terms of closed nonprofits. But if you have the W-2s, you should be able to reapply.
Yeah, you should be able to reapply. And then also, I recommend getting in touch with one of your lawmakers' constituent services team. You can request help with a federal agency, and that way they can be the middleman between you and the servicer or the Department of Education to be able to see what the holdup is and what the issue is, and hopefully get that application to count.
Thank you so much, Sabrina. I see a question from Anonymous. I think this refers to the current public service loan forgiveness negotiated rulemaking and final rule. If someone has 80 payments that qualify and they change the qualifying employer criteria, will that person be grandfathered in or will they no longer qualify? The answer is we don't know yet. We are waiting with bated breath for this preliminary rule. It will just be a preliminary rule. There will be another public comment period. We will notify you all about that, where we can get very loud, but we don't know how the restrictions to the new public service loan forgiveness, where that can be taken away if you work at a job that frankly the administration just doesn't like. We don't know how that's going to work, but that's a really great question. And that's the type of question that we will take back to our policy partners and lawyers to see if they have any additional insight. And then, and Angela, again, it's an all or nothing program. She asked, what if I'm no longer working at my 501c3 employer, but I work for another, I was working my previous employer for 7.5 years. Well, if you're working for another nonprofit or PSLF qualifying employer, that is fine. You do not need to work in the same job for 10 years. That's actually a great just piece of advice. You can change jobs as long as that is a qualifying employer. Many people have 2 or 3 or more employers in a given 10-year period of time that are all public service loan forgiveness qualifying employers, and that is perfectly okay. All right, let's talk about the public service loan forgiveness buyback program. We have been told that this is back up and running. We are still waiting to see people successfully go through buyback. I will use that as a caveat, but what is it? You can buy back certain months in your payment history to make them qualifying payments for public service loan forgiveness. Specifically, you can buy back months that don't count as qualifying payments because you are ineligible due to a deferment or forbearance status. We do know that time spent in school deferment can never be bought back. So who can benefit? The buyback opportunity is only available once you've hit that 120. So if your calculation is 120 months, but you're looking at the Department of Ed, you're looking at your PSLF tracker and you see that they have 112 months, but you know that you worked in your qualifying job, you had a student loan. There may be an opportunity to buy back months of forbearance or deferment, including the SAVE forbearance, so you can then get public service loan forgiveness. And that's really important. Sabrina Ashley always says when we talk about this slide, you are buying the past, not the future. So it can't be that you're at 110 and then you want to buy the remaining 10 credits. This is if there's discrepancies, specifically forbearance deferment. In theory, we'd love to see this work for the SAVE forbearance because people stopped earning their credits as of June or July of last year when the litigation started. We know many borrowers that would have reached their 120 months. They have still had a student loan. They have stayed in their job. For all intent and purpose, you should be able to purchase back those months and then have your loans forgiven. So borrowers, as I just said, may be eligible with the court injunction. You must submit a buyback request and make an extra payment of at least as much of what you would have paid under an income-driven repayment plan prior to when you were on a forbearance. So whatever you were paying prior to that forbearance period of time, you would have to make at least one payment, and then you would also have to make the payments of those months that you need to buy back. All right, so loan consolidation. We're going to stress that due to the current regulations, if you consolidate right now, you may erase some or all of your repayment history, specifically your income-driven repayment history and your PSL, public service loan forgiveness progress, because you are creating a new loan. This will also extend your payoff date and restart your public service loan forgiveness credits to zero. I want to add a caveat to this, as Sabrina Calazans mentioned, that Parent Plus borrowers who have never consolidated, so they're not in an ICR program, they've not converted their one loan into a direct loan. They are some of the folks we are actually stressing to consolidate so they can get onto income-based repayment prior to the July 2026 deadline. But what is consolidation? It's about converting an older loan into a new direct loan or combining multiple loans into a single loan. You're creating a new loan and you will receive a new payoff date. And the process will take anywhere from 30 to 60 days. You can consolidate a single loan, as I just mentioned, of a Parent Plus loan that can be consolidated into a direct loan. If a parent has already consolidated and they are on income contingent repayment, they should be able to move to income-based repayment, which will be a slightly less monthly payment for them. So that's another option for Parent Plus borrowers that is available until July of next year of 2026. So the requirements needed for consolidation: you either need a single FFELP, Federal Family Education Loan Program, but Federal Family Education Loan, or if FFLP consolidated loan can be consolidated, or as we like to say, converted to a direct consolidation loan, so your client or yourself can benefit from public service loan forgiveness. If you're consolidating an existing direct loan, you must have at least one other loan that you are combining that with. Right, good on questions. So new loan consolidation changes. Parent Plus loan holders looking to enroll in the income contingent repayment plan or income-based repayment will need to consolidate their loans into a direct consolidation loan and enroll by June 30th, 2026. We strongly stress that if you have clients or yourself that wants to do this as soon as possible. We know that last year, right before the SAVE lawsuit, when people were consolidating to get on SAVE, and it was so close to the consolidation deadline that was going on last year, many applications got lost and just kind of the borrowers never got responded to. So I highly recommend doing things well before these deadlines, because there's going to be a huge backlog yet again on top of the current backlog. We do not recommend, and at this point, as of today, until we receive future guidance, we don't recommend anyone consolidate their loans after June 30th, 2026. As Sabrina was mentioning, that will thus create a new loan after that deadline, and then you will only be able to enroll in the RAP plan. So if you want to still be able to enroll in the income-based repayment plan, income contingent repayment, or pay as you earn, which those two plans will be still available until 2028. We do not recommend anyone consolidating their loans after June 30th of next year. Borrowers that take on a new loan, including the consolidation of an existing federal loan on or after July 1st, will only be eligible for those two plans, the standard or the RAP. You apply for consolidation in the same way that you apply for income-based repayment programs. You can go to studentaid.gov/loan consolidation. You can do so using a paper form or online. We highly recommend doing online applications. If you're consolidating your loans and you plan to enroll in an income-driven repayment plan, you must submit both at the same time, both your consolidation application and the IDR application at the same time. They'll sound like a broken record, but due to the current regulations, if you consolidate right now, you could erase your income-driven repayment history and your public service loan forgiveness history by creating that new loan. With all the things we're talking about today, processing times are extremely delayed, and it can take upwards of 30 to 90 days or longer. However, you should be placed into a processing forbearance during this time. You will accrue interest, but you will not have to make a payment. All right, we're almost there. I appreciate you all sticking with us. So additional forms of loan forgiveness and cancellation. We're just going to go through this quickly, but it's always, a good thing to run through with your clients to see if there's any other way you can get their loan discharged. So total permanent disability, TPD. This provides full forgiveness on your federal student loans if you or your client is totally and permanently disabled. Borrowers must provide documentation either from the VA, Social Security Administration, or a medical professional. Typically, it's a medical professional. You cannot be working during a 3-year you cannot be working at all, and a 3-year monitoring period will apply. This is not, if your client is on disability but still working, this does not apply to them. It needs to be total and permanent disability, meaning absolutely no work. This had been delayed, but did resume in the spring. There are other, I'm not going to go into them, but just a reminder is borrower defense to repayment, teacher loan forgiveness, which is separate from public service loan forgiveness. If you teach at a Title I school or an education agency, you can have some of your loans forgiven, $5,000 to $17,500. This cannot be done at the same time as public service loan forgiveness. Death discharge, federal loans die with you. This is not something that you would pass on to a loved one, a family member. Unfortunately, this is bringing people some solace right now with all of these changes. Closed school discharge, if your school has closed down, this largely applied to the for-profit schools. We saw a lot of them closing down in the early 2010s. Unpaid refund, as I mentioned before, you should be able to get a refund if you overpay. False certification, this means that somebody has taken out a loan illegally in your name. And Perkins Loans Forgiveness, which is forgiveness from the school itself. All right, here is what folks can do right now. Make sure you and your clients know who your loan servicer is and have access to your account. This is both at studentaid.gov and your loan servicer. Save any communication documentation you've received from your servicer. Print, download, screenshot, and save anything that details how many public service loan forgiveness credits and income-driven repayment credits you have if this applies. Again, another reminder for Parent Plus loan holders, those who have loans parents that have loans for their child who have not yet consolidated their loans and would like to enroll them in an income-driven repayment plan will need to consolidate and apply for ICR or income-based repayment before July 1st of 2026. I'm going to just take a look at the questions real quick. Anonymous asks, I have a Parent Plus loan and am I required to consolidate or continue to make payments? You're not required to consolidate. If you're able to make the payments and that is okay, then you are fine. It's if you want to enroll in a income-based repayment plan, then you would need to consolidate prior to June 30th of 2026. I also see Valeria, apologies for mispronunciation of names, but asking how to advise clients on the best option for them. This is always a personal choice. We provide all of the plans for borrowers, and then I would recommend using the student loans simulator at studentaid.gov to go through to see what plans the borrower is applicable for. And we, as experts, but not financial counselors nor attorneys, we stay away from telling borrowers exactly what plan is right for them. And then we have another question from Anonymous. So if borrowers apply for ICR, IBR before July 1st, 2026, their payment plan will be honored and kept for the loan. But if they wait until after, they will only have the standard plan or RAP plan, correct? That's for federal student loan borrowers. Parent Plus borrowers do not have the option to enroll in the RAP plan. Just to clarify. So that's why we're encouraging parents to consolidate right now, because they will be able to enroll in a couple of income-driven repayment plans. If they don't do that before July of next year, then they will not be able to, because Parent Plus loans are not applicable for the RAP program. Okay, so with all of this, we know a lot of people have issues and complaints. There is the FSA Financial Student Aid Feedback Center, which allows you to file complaints, report suspicious activity, provide positive feedback concerning funds, grants, or loans managed by the Department of Education, and you can submit the complaints. I just read Tyler Kincaid wrote, I believe in HuffPost, that there are thousands and thousands of unresponded to complaints right now. And because of that, we are also suggesting that borrowers submit complaints to their representatives' offices, state attorneys general offices, local and state student loan ombuds people, if you have them in your state. We work closely I'm here in California with the California Ombudsman, and Connecticut and many states do have ombuds people. So that is another avenue. You can always call your servicer or go through your servicer's website, chat, message function, phone, and email. If you do that, try your hardest to document the information the best you can. And I believe our team will share the casework tool. And this is a way that you can contact federal representatives and submit complaints. Most, if not all, of our senator and Congress people's offices have caseworkers that can try to get answers for you. With the reduction in force, answers from the Department of Education are few and far between. Okay, so before I get into the volunteer, one more question. I've worked for Anonymous. I've worked for a nonprofit organization for 30 years, and I have a Parent Plus loan. Are there any forgiveness options available? So Anonymous, if you had consolidated at any point and have a direct loan, then it is possible, even if you're just hearing about public service loan forgiveness today, that all time after 2007 would count. If you consolidate now, unfortunately, the clock would start with the next 10 years. So it's hard without looking under the hood, so to speak, but you may qualify. It just depends on if you have a consolidated direct loan and you remember consolidating at any point. All right, with that, there are no open questions at the moment. So I'm just going to plug our volunteer opportunity again. You all have asked really great, insightful questions. I'm sure you have more. We constantly do on a daily basis right now with all of the changes. So if you'd like to get involved with us more, and specifically as a volunteer, I will say you are already doing the work. By being a housing counselor, by joining our workshop today, that is essentially what we're looking for. People that will share these resources with their loved ones, friends, colleagues, clients, your networks, whomever you'd like. We will provide you resource packet beyond this slide deck that you're going to get today. You can use these resources to help your clients better understand the option. You can utilize our team to ask questions. If you sign up to be a SDCC volunteer, we are offering for NHRC an exclusive hour-long office hour, August 19th at 2 p.m. Eastern. If you sign up to receive resources and come to this event. We do plan to host another office hours sometime in September, but we would love to, start working with you all, answering your questions and getting our resources to you. As I mentioned, since you're already doing this work, it's a relatively low lift. All you need to do is fill out our volunteer form, which is being shared in the chat. If you'd like to continue getting these updates and working with us, you can visit our website at studentdebtcrisis.org and follow us on social media, all handles at all handles debtcrisis.org. There's a quick resource guide, but we do have a lengthier resource packet for people that sign up to be an SDCC volunteer. And I can just leave it on the resources for folks. And with that, I believe that concludes our presentation portion of this and would open it to any additional questions.
Thank you all so much. What a ton of information. And I just have to say, I'm pretty glad that I don't have a student loan right now. I do have one question for the RAP program. A similar question was asked about one of the other payment plans, but for RAP, if you make an extra payment, does it shorten the term?
Unfortunately not. Same thing applies for public service loan forgiveness. What matters on an income-driven repayment plan for RAP, for IBR, for all of those is the number of credits that you have at the end. So you need for RAP 360 credits, but each month is just one credit. You can't make two payments to get two credits. So it is one payment per month that counts towards the number of credits needed for forgiveness at the end.
And do you see the question in the chat? Will there be training if people are looking to volunteer?
Yes.
Absolutely.
Yep. If you fill out that form, we are going to reach out to you about that office hour for folks to come with any specific questions and go over anything that we missed today.
And if you cannot make the office hours, there will be additional trainings for volunteers. Yes.
And I echo your sentiment, Cheryl, that it's a bit overwhelming but necessary, all this information. So no more questions have come into the chat, and I want to say thank you again to the Student Debt Crisis Center folks. This was great. Again, so much information, and you did a really nice job laying it out and answering all the questions. So thank you. With that, I think we'll give the screen back to NHRC with our slides. And I do want to make another plug for membership. And a couple of people did ask about resources for help with walking people through some of this stuff. And one of the things I want to point out, Student Debt Crisis Center has this wonderful opportunity that they've shared that you can be part of. But also, we do have membership discounts for savvy student loan help, and also for the student debt solutions. So both of those opportunities give you the ability to get some direct assistance with student loan experts, and your clients can sign up, you can sign up to get this direct assistance. And again, these are membership discounts, and if you're interested, you can get in touch with Ebony, our membership guru, and she will talk with you about these discounts and how to access them.